So you might be asking this question, can retirement funds be used as collateral for a loan? Well, the answer might surprise you because it's yes, but there's a but on it. So stay on here for what you can actually do and maybe some other alternatives of what you could do instead of what you might be thinking. All right, so number one, yes, you can actually use retirement funds as collateral for a loan, but there are a lot of restrictions. So for example, many banks will only offer you a 50% line of credit for those retirement funds. Why? Well, most importantly, it's because you're invested in the stock market, right? If you're in mutual funds, banks usually won't let you go over 50%. They don't want you to really risk your money that way. They're afraid of you to do that. Now I'm talking about especially if you're trying to get a normal bank loan, right? If you're just trying to get any kind of collateralized loan. So for example, we have clients that sometimes will say, all right, I need to have collateral for this special kind of life insurance strategy that we teach for people that have high net worth of over $10 million. And they could actually get the bank to finance all their premiums for them, like pay for their entire life insurance policy. But the banks need some collateral just for some safety, especially in the beginning when you're trying to build up that cash value. Well, the problem is if someone says, well, I've got this mutual fund, I got this brokerage account, they will only go up to maybe 50%, depending on what you're invested in. Now, if you put your money in just a simple savings account, no, say, oh, 100%, we'll let you have it. But if it's invested in mutual funds, they're gonna say, well, that's risky. You could lose a lot of money potentially, possibly even 50%. So we're gonna give you a line of credit for that. Just as a warning, do not get caught in the trap because if you're invested in a lot of stocks and options or things like that, and I taught this when I used to teach people how to trade stocks and options, people would use what's called borrowing on margin, right? They would use a margin type of account to do that. Same thing, they would only let them use the same amount of money. They would actually give them 100%. But if you bought a stock using that margin and the stock goes down, they would do what's called a margin call, which means they force you to sell that stock so that at least they get their money back. So for example, let's just say the stock is worth $10 a share. So you put in $5 of your own money, and then you put in $5 of their margin money, the borrowed money. That's $10. So you bought one share of that stock. Now the stock goes up, you feel like a hero because now it goes up, say it goes up to $20, your $5 now is worth $20. Right? So you can still pay off the 5 and now you've just made $10 profit. You just made an extra 200% return on the money that made 100% return. Does that make sense? So you actually double your returns that way. But the inverse is also true. If you lose money, it's much, much worse because if you put in $5 and then they put in $5, and let's just say the stock price goes down to $6. Well, at that point, they're gonna say, we need our money back. They're gonna take their $5 back, leaving you with the $1. Right? That's it. So your $5 now is worth only $1. You just lost 80%. Instead of losing 40%, like it dropped 40%, you lost 80. So not only can you gain double, but you can lose double. I had one particular student in a stock coaching company I worked for where he decided to do that. He didn't wait to learn how to do this. He was so excited he could use margin. He went and he bought options. By the way, just so you know, options are like stock investing, but much more risky, much more volatile. You can lose money quickly. I've had lots of friends lose everything investing in options. Well, he went and put his money in options, did it on margin. Then the banks came back and they saw what was happening to the stock price or the options price. So they sold him out. They made him sell out of it. He lost 90% of his money, 90% of his own money. The banks got all their money back, but he lost 90%. So you gotta be careful with this. So that's why banks don't like to have it when you've got retirement accounts where you got it in mutual funds and things like that. They don't want to give you a lot of money on lines of credit for that very purpose. Now, there's also other things too. Understand that 401ks, you could get a loan off your 401k, right? You can do that, but they have limits. You know, for example, if you have a 401k with $200,000, they will cap you at $50,000. So really the rule is this: 401ks will either let you get a limit up to 1/2 of the money you have, again, 50% of your money, or $50,000, whichever is less. So like in that example, they won't let you have 100,000 of the 200,000, they'll only let you have 50. Now, if you have 25,000, they'll let you have 12,500, 50% of that. So in 401k companies, those companies will allow you to get a loan from them, but you need to pay yourself back interest when you do that. So you're paying yourself back that money, and they require those monthly payments. So if you borrow $50,000 from a 401k, the payment's usually roughly about $900 to $950 a month coming out of your paycheck that you cannot stop. You have to pay that every single paycheck. So just be aware, you could do that, but that's gonna be a little bit risky too. Now, what about the alternative investment side? What about things like buying real estate and things like that? Well, it's a little bit different with real estate, because real estate is a more secured asset, right? It's not like you're just borrowing money to go invest in stocks. You're not just borrowing money to put into a new business venture, which they would also consider kind of risky. They know that real estate actually has an asset backing it up. but there are some rules there too. And they call them non-recourse loans when you get a mortgage loan with it. Now you could just use your IRA money, like your money that way, and just go and invest in these things directly. That's called a self-directed IRA or self-directed 401k. You could do that. But again, if you're trying to borrow money and you're trying to leverage your retirement account, they're gonna put some different rules on you. So for example, normally if you buy an investment property, especially when early on when you're starting to do this, the mortgage companies will require you to put 20% down on that property. But if you use IRA money, if you're trying to use your retirement account money, they will require double that down payment. You'll need to have at least 40% down. Some cases you'll have to put 50% down payment to use your IRA money to invest in that real estate. Also, those mortgage loans usually have a higher interest rate too. So not only do you have to put more money down, which means that your ROI usually goes down too, your return on your money goes down, but also at the same time, the interest is going up on those loans. So you're paying a higher interest rate, which affects your cash flow, and your cash flow isn't as good because you're putting more of your money into that property versus using the bank's money. And so your cash on cash returns are less, and your interest rates are higher. So it's not that you can't do it, right? You could definitely do it. It could actually work out great in your favor. But just understand that if you're trying to borrow money, for that down payment using your IRA money to then get a mortgage, you have to do that too. Also, you got to be careful too because there's things like other taxes that could be involved if you're trying to use self-directed money versus just getting a loan. But just understand that yes, you can actually buy real estate getting a loan from your retirement account, but you will do double the down payment and there will be higher interest rates. So what do my clients often do? Usually we try to save outside of these plans so you can get better loans. This is why we often talk about things like infinite banking, right? We talk about using that money instead where you can use it for however you want. There's not any restrictions. Usually with infinite banking, you can get access to 95% of whatever cash is sitting in there at any time. Why 95% instead of 100? Well, because they want to keep the 5% in there just in case you have to cover insurance costs and things like that, in case you don't pay the money back or you just let the interest compound because you don't have minimum monthly payments. So they give you a little buffer there to protect against that interest accruing on your balance there. But yes, you can save outside these plans and have better loans. So heck, you can even save in a savings account and leverage a savings account, get a secured line of credit and go and invest in these things. I wouldn't do that personally. I don't think it's really worth it. I'd rather just put my cash in and secure bank money in other ways, like getting a mortgage on those investments and things like that. But this is why when you save outside of these retirement plans, there's so many more options, so many less hoops to jump through and red tape to cut through and all that kind of stuff. It's so much easier just to invest without all of the issues and the rules that go along with the retirement accounts, especially the qualified retirement accounts like IRAs and 401ks. So that's what you really want to do instead, is save outside of those. And instead of just saving it in the bank, like I said, you could do it with infinite banking, put it into your life insurance, allow it to grow there. And then the cool thing is, especially as you start to let it grow, even though you can do this really in the first year, really after 30 days, you've got access to your money and your cash whenever you want. But what happens is, especially as this money grows, you can actually use this money to leverage, and you can make money in two places at once. You can make money inside the life insurance and get a bank line of credit against the cash that's also in there. So you're still earning tax-free dividends on that money, usually at least 5% plus, and you can still get a line of credit from the banks and use that money to invest, earning returns there too. So you actually make money in two places, earning more cash flow as a result. Very great strategy to use, especially if you want to accelerate your ability to buy more assets and really get out of the rat race faster, especially over the next 5 or 10 years. If you have a retirement goal to do it in 10 years or less, this could be a great strategy. So that's what I prefer to do in my own case because I don't like rules. I like to be able to have flexibility and options, especially as markets change and things change in that kind of situation. Not to mention, what if the retirement account drops? What if it drops another 20% like it did in 2022? Now you have less money to use. So I like to have my money secure, safe, liquid, and available to use to be able to invest however I want based on what the market conditions look best. So guys, hey, check out this next video. If you like this retirement funds one, there's other things you can do with your retirement funds that you may not know about. So check out this next video.